In this FAQ video, I am going to talk about annuities. There are hundreds of variations of annuities, and it is important for investors to understand how an annuity is structured, how it is invested, and how much they cost, so they can make an informed decision as to whether an annuity is in their best interests. So what exactly is an annuity? An annuity is a contract between a purchaser and an insurance company. In most cases, the reason why somebody buys an annuity is to earn a steady income stream during retirement. Another thing to remember is that annuities are tax-deferred, which means that the earnings and gains in the annuity build up tax-free, so you don't get taxed on these earnings until you start taking distributions. So they function like an IRA or 401k account. For disclosure purposes, I want to make it clear that Andrew Hill Investment Advisors does not sell annuities. In fact, we don't sell any financial products. But from time to time, we do get a lot of questions from clients who have either bought an annuity and they really don't understand how it works, or they are thinking about investing in an annuity. Over the past 11 years, I have analyzed more than 50 different types of annuity products. Generally, annuities come in four main categories: immediate fixed, deferred fixed, indexed, and variable. Let's start with the immediate fixed income annuity. These types of annuities are the least complex and tend to have low commissions and fees. You purchase this annuity with a lump sum of cash, then the insurance company promises to pay you an income stream for life or for a set period. You don't pay a direct fee when you purchase an immediate annuity. However, the charges are worked into the interest rate. Rates are determined so that the insurance company will make more money if you die earlier than expected during the contract term. On the other hand, if you live longer than expected, you will make more money and the insurance company loses money. Fixed income annuities typically pay between 3 to 4% more than the 10-year Treasury bond. The payout options also determine the monthly amount that you will receive. So if the contract is set to pay out during your lifetime, you usually get a much higher payout versus taking out a contract on a joint life, such as for married couples. The second type is a deferred income annuity. These types of annuities are structured the same way as the fixed income annuity, but the payments start at a much later date. The longer you defer taking payments, the higher the income stream will be. The third type are indexed annuities. This is a type of annuity where the income payments are tied to a stock index, such as the S&P 500. One of the main drawbacks to indexed annuities are interest rate or rate caps. Rate caps set the maximum rate at which the annuity can grow. Most caps are set at 4%. For example, if the S&P 500 index returns 7% in the quarter, but your rate cap is 4%, then you will only earn 4%. For this reason, indexed annuities are not attractive because you lose out on any upside. Liquidity can be a problem with indexed annuities due to their surrender periods. This is the waiting period before you can access the funds without incurring a penalty. Surrender periods range from 7 to 10 years, although I have seen some contracts stretch out to 20 years. The maximum amount you can withdraw from an annuity without incurring a surrender charge is 10% per year. So it's not a good decision to invest all of your savings in an annuity like this because of the surrender fees and the risk and the lack of liquidity. Finally, the mother of all annuities and the most common type is the variable annuity. Variable annuities are the most complicated and expensive annuities. They were originally intended to be a form of asset accumulation, where you have a tax-deferred account that is invested in a range of mutual funds. Just like with an IRA, these funds cannot be withdrawn without penalty until age 59 and a half. Otherwise, all withdrawals are subject to ordinary income tax. Variable annuities are generally suitable for clients who do not have qualified plans such as IRA or 401k accounts. Variable annuities have become a gold mine for insurance companies because they are very expensive. If you were to purchase what I call a plain vanilla variable annuity, the average cost is about 1.5% per year. However, 80% of variable annuities are sold with income riders as a way for their insurance company to entice you to customize your retirement plans by guaranteeing a minimum amount of income you will earn, such as 5 or 6% per year. Truth is, these riders are very expensive and can be very misleading. Income riders will increase the cost of the contract by another 3% or so. And by the time you include the fund level fees, you can expect to be paying on average 5% per year. Finally, variable annuities come with surrender periods that I described earlier in this video. As you can see, it is important for investors to do their research before they consider purchasing annuities. And our firm is happy to help you evaluate the pros and cons of annuity products to make sure they're in your best financial interest. Andrew Hill Investment Advisors is here for all your investing needs, including annuities. For more information on financial topics such as this one, follow us on social media to view our other FAQ videos.